Before the late 20th century, securing a bank loan was a subjective theater of human judgment. You did not walk into a financial institution armed with a standardized metric of reliability. Instead, you sat across a mahogany desk from a loan officer who evaluated your character based on occupation, neighborhood, demeanor, and often race or gender. This handshake system, governed by local prejudice, locked millions of capable borrowers out of the financial system. This manual consumer credit assessment was not just biased, it was wildly inefficient for a rapidly expanding post-war economy. Banks operated as isolated fiefdoms, maintaining localized records that could not be scaled. If a borrower moved, their financial reputation vanished, forcing them to rebuild trust from zero. The industry desperately needed a universal language of risk to strip emotion from lending and fuel mass consumption. The solution emerged from the minds of an engineer and a mathematician. Bill Fair and Earl Isaac recognized that subjective evaluation in lending was fundamentally flawed. They understood that past financial behavior, analyzed through statistics, could predict future repayment far more accurately than any banker's gut feeling. Their radical vision was to reduce the messy reality of a person's financial life into an objective mathematical formula. To monetize this theory, the two men founded the Fair-Isaac Corporation in the late 1950s. They pitched predictive models to local lenders, promising to automate decision-making and reduce default rates. Early iterations required manual data entry on punch cards, but the underlying philosophy was revolutionary. By assigning numerical weights to borrowing behaviors, they laid the groundwork for a standardized system of algorithmic lending. The true turning point arrived with the 1989 adoption of the first general-purpose FICO score. Prior models were custom-built, but this new iteration was a universal metric designed to be pulled instantly from national bureaus. Suddenly, a borrower's risk profile was summarized in a single three-digit number. This innovation transformed slow underwriting into an instantaneous, frictionless transaction executed millions of times a day. Not everyone welcomed this algorithmic revolution. Veteran bankers initially balked at surrendering authority to a black box formula. For generations, granting capital had been the defining privilege of the local bank manager. The prospect of an invisible mathematical model dictating loan approvals felt like a direct threat to their expertise. Many institutions dragged their feet, clinging to the illusion that human intuition could outperform aggregated data. However, sheer economic efficiency quickly crushed any nostalgic resistance. Lenders embracing the algorithm processed applications in minutes, dramatically lowering overhead while reducing exposure to bad debt. This speed allowed for the mass mailing of pre-approved credit cards, sparking an explosion in consumer debt. Banks that refused to adapt simply could not compete with the volume and velocity of capital moving through these automated pipelines. This shift changed banking forever by turning debt into a mass-manufactured commodity. Because the FICO score standardized risk, loans were no longer idiosyncratic agreements. They became uniform financial products, easily priced, packaged, and traded on the open market. The algorithm provided the mathematical bedrock required for the explosive growth of securitization, where thousands of mortgages were bundled and sold to global investors. Wall Street's insatiable appetite for these securitized assets cemented the metric as the ultimate arbiter of global capital flows. Investors in Tokyo or London did not need to know individual borrowers in California. They only needed the average credit score of the bundled debt. This abstraction allowed the financial system to scale to unprecedented heights, funneling trillions of dollars into lending. As the financial sector grew dependent on this metric, its influence bled outward. It ceased to be merely a banking tool and mutated into a universal measure of human character. Today, landlords screen tenants, telecommunications companies approve contracts, and auto insurers calculate premiums based on this data. Even employers pull reports to gauge applicant responsibility, linking a person's financial past directly to their future livelihood. For the average citizen, this pervasive surveillance fundamentally altered the psychological experience of personal finance. Managing one's score is a lifelong, high-stakes game with undisclosed rules. A single missed payment can trigger financial penalties, trapping individuals in high-interest subprime lending. If your number drops too low, you do not just face higher borrowing costs. You risk becoming financially exiled, stuck in an inescapable system. What makes this power so unsettling is the proprietary nature of the algorithm. The exact mathematical weighting remains a closely guarded corporate secret, shielded from public scrutiny. Consumers receive general guidelines on improving their standing, but the precise mechanics are hidden behind intellectual property law. We have outsourced the distribution of economic opportunity to an opaque, privately owned black box. To maintain dominance, the corporation continuously refines its models to account for shifting consumer behaviors. When the housing market collapsed or global spending habits altered, the underlying algorithms were quietly recalibrated. Marketed as improvements in predictive accuracy, these adjustments reinforce the company's indispensable role. The architects constantly maneuver to ensure their metric remains the industry standard, regardless of how the economic landscape shifts. Despite these refinements, the algorithmic approach contains deep structural flaws. Relying entirely on traditional data creates a massive blind spot for millions of credit invisibles. Individuals operating in cash are effectively ghosts in the machine. Furthermore, because the algorithm relies on historical data, it often amplifies past systemic inequalities. A mathematically objective formula still produces unequal outcomes if its feeding data is inherently skewed. Recognizing these blind spots, financial technology startups have attempted to disrupt this monopoly. Challengers leverage alternative data points, analyzing utility payments or bank account cash flow to build a more inclusive picture of reliability. Yet, despite billions in venture capital, unseating the incumbent has proven nearly impossible. The entire infrastructure of modern finance is structurally hardwired to demand the traditional three-digit standard. This entrenched reality presents a profound historical irony. The system was originally conceived as a democratizing force to strip prejudice from banking and replace it with blind, egalitarian mathematics. In many ways, it succeeded, making borrowing cheaper and more widely available. Yet, by quantifying reliability, the algorithm inadvertently created a rigid caste system. The subjective bias of the loan officer was replaced by the unforgiving memory of the database. We now live in a world where upward mobility is mathematically gated. The three-digit number dictates who buys a home, who starts a business, and who participates in wealth-building mechanisms. It is a silent tether following every consumer from their first credit card to their final mortgage payoff. The transition to algorithmic certainty promised unprecedented fairness, but delivered a system where past mistakes are permanently etched into digital identity. The invention of standardized scoring is arguably the most consequential financial innovation of the late 20th century. It is the hidden architecture that allowed the banking industry to scale globally, transforming debt into a tradable commodity. The algorithm did not just change how banks operate, It fundamentally rewired the economic reality of the modern world, proving that the most powerful forces in finance are often the ones we cannot see.